All right, let's dive into a real head-to-head battle between two very interesting funds, YMAG and MAGY. Now, both of these are trying to do something that, honestly, sounds a little too good to be true. They want to squeeze a high income stream out of the biggest, baddest growth stocks on the planet. So, how do they do it, and which one does it better? Let's find out.
So let's start with the big question, right? You've got these absolute titans, the Magnificent Seven, just dominating the market. But for anyone who needs to live off their investments, there's a huge catch. These companies are all about growth, not about mailing you dividend checks. So, what's the solution? How do you get a paycheck from stocks that don't pay one?
And that, right there, is what we're calling the Magnificent Seven dilemma. I mean, their growth is just off the charts, but their whole game is to pour every spare penny back into the business to get even bigger. That leaves income investors kind of standing on the sidelines, wondering how they can get a piece of the action without giving up that cash flow they need.
Well, to solve that exact problem, two main contenders have stepped into the ring. In one corner, we have YMAG, and in the other, we have MAGY. Both of them are ETFs, or exchange-traded funds, and they're built from the ground up to try and turn this group of growth stocks into an income machine.
Okay, let's get formal for just a second and look at the tail of the tape. YMAG's full name is the Yield Max Magnificent Seven Fund of Option Income ETFs. Wow, that's a mouthful. MAGY is the Roundhill Magnificent Seven Covered Call ETF. The names alone give you some clues about how different they are, but the real story is in how they're actually put together.
And here is the absolute key difference. YMAG is what's known as a fund of funds. It's pretty complex. It doesn't own the MAG 7 stocks directly. It owns 7 other ETFs and then uses some fancy financial engineering on top of them to generate income. MAGY, on the other hand, is way more straightforward. It basically holds the 7 stocks and then writes what are called covered calls. You can think of it as selling someone the right to buy your stocks later at a higher price, and you get paid a fee right now for making that deal.
Now, all this financial wizardry doesn't come for free. Compared to a plain old index fund, both of these are kind of pricey. YMAG is going to cost you about 1.28% a year. MAGY has a similar sticker price, but they're waiving some fees, which brings the actual cost down to just under 1%. So, a slight edge to MAGY on the cost front.
Okay, so that's the high-level view. But to really get what's going on here, we have to pop the hood and look at how these things are really built. This is where we get into the structure, that eye-popping yield, and, yeah, some of the hidden risks you need to know about.
Now check this out. This quote comes straight from YMAG's own official paperwork, and it perfectly sums up the big trade-off for both of these funds. What it's saying is that your potential for gains is limited. If these stocks shoot for the moon, you're only going to get a small piece of that ride up. But if the stocks crash and burn, oh yeah, you're on the hook for all of the losses.
So you're probably thinking, wait, capped upside and full downside? Why would anyone sign up for that? Well, this number right here is the reason. It's the bait. Both funds have dangled these unbelievable yields, sometimes over 30%. It just screams too good to be true. And you know what they say about that?
So where in the world does a 30+% yield come from? Well, when we break down one of YMAG's actual payouts, the answer is kind of shocking. Take a look. Only about 4% of that big check they sent out was actual income from the strategy. The other 96%? It was something called return of capital.
So what on earth is return of capital? It's a really important concept to grasp. It's not profit. It's not earnings. It is literally the fund taking the money you invested and just handing it back to you and calling it a yield. It can make you feel like you're getting a great return, when in reality, the fund's underlying value could be going down. For a long-term investor, this can be a massive red flag.
Okay, so we've looked at the strategies, we've looked at the fees, and we've uncovered that big catch with return of capital. Taking all of that into account, the source material we're analyzing here, well, it comes to a pretty clear conclusion about which fund is the better bet for a long-term portfolio.
Let's just ask the question straight up. After weighing all the evidence, if you had to pick one of these to stick in your portfolio for the long haul, for most people, which one should it be?
The analysis points to a clear winner for most investors who are focused on building a sustainable, long-term income stream, and that winner is MAGY.
So why does MAGY get the nod here? Well, it really boils down to a few things. First off, it's just simpler and more transparent. You actually know what you own and how it's making money with that classic covered call strategy.
It's also got that slightly lower fee, which helps. But the biggest thing is that the whole structure just feels more aligned with the goal of creating real, sustainable income over time, not just generating a crazy headline yield for a month or two.
All right, so we have a verdict, but knowing the winner is just the start. Let's talk about what this actually means for you and your portfolio, because it's crucial to understand the key takeaways and the big picture risks that frankly still apply to both of these funds.
Now, saying MAGY is the better long-term hold doesn't mean YMAG is useless. Not at all. Think of it as a very specialized tool. For someone whose one and only goal is to get the biggest possible check in their hand today, and who fully understands that it might just be their own money coming back to them, well, YMAG could still have a place in a very specific, maybe more speculative, strategy.
And please, remember this part. It is absolutely critical. Both of these funds share the same fundamental risks. You're betting everything on just 7 stocks. You will miss out on a big chunk of the gains if the market goes on a tear. You are not protected if the market crashes. That high yield can be eating away at your original investment, and they both charge high fees. These are not your typical set-it-and-forget-it index funds, not even close.
Ultimately, the choice between these two funds, or even deciding to invest in this kind of strategy at all, it really boils down to this one simple question you have to ask yourself. You are making a direct trade-off. Is getting more cash in your pocket today worth sacrificing the potential for your investment to grow bigger tomorrow? And honestly, only you can decide if that's a price worth paying.